And welcome to Finance Concepts with your Finance-ista Cynthia Bush. So let's examine preferred stock. First of all, what is preferred stock? Well, it is simply an equity security that has some features that are similar to debt. And in a bankruptcy scenario, preferred stock actually comes ahead of common stock in terms of the right to receive funds. Pictured on your screen is an old paper certificate of preferred stock from way back in the day. A company would issue these preferred stock shares to investors in return for cash. So in a bankruptcy scenario, when the company can no longer make good on all of its promises to repay its debts, its assets are seized and liquidated, and the money from those assets are paid out in a certain order. The accounts payable creditors get paid first. So they're the ones who have sold inventory to the company or finished goods and haven't been paid yet for them. If there's any money after paying the accounts payable creditors, then the secured bondholders get paid, followed by unsecured bondholders and subordinated bondholders. If there are funds from the asset liquidations available after all the bondholders have been paid, then preferred stockholders are next in line, followed by common stockholders. Note that in the real world, frequently when the assets are liquidated, there are not enough funds to cover all of these groups. So your accounts payable creditors might receive some or all that they're owed. Your secured bondholders, same thing. Once you get below the secured bondholder level, it can be challenging for the other security holders to receive any money, and particularly your equity holders who are at the bottom of this list. So if you look at it, in addition to being the liquidation preference in a bankruptcy scenario, this is also a list of the riskiness of these securities relative to one another. Notice that common stock is the most risky because they are last in line in a bankruptcy scenario to receive any money. And right before them are preferred stockholders. And then, of course, before them are your bondholders and then your accounts payable creditors. So that's why common stockholders expect and hope to receive the highest returns relative to these other security holders because they are taking on the most risk relative to these other security holders, and preferred stockholders are taking on the second most risk. And so they are expecting the second highest returns. Okay, so let's take a look at some of the characteristics of preferred stock, and then we'll compare it versus other securities. First, preferred stock is issued in the capital markets. That means it's viewed as long-term financing. Preferred stock pays a fixed dividend. The dollar amount of the dividend is calculated by multiplying whatever the percentage of the dividend payment is times the company's preferred stock par value. Note that dividends on preferred stock are not tax deductible to the company who is issuing the preferred stock, and investors who purchase preferred stock cannot force a company to bankruptcy, even if the company has not paid the dividends that they're supposed to on the preferred stock. Preferred stock can be callable at the company's option, and sometimes, depending on the preferred stock issue, it can be convertible into common stock at either the company's option or the investor's option. Since there's no maturity date on preferred stock, it is assumed that the dividend that is fixed will be paid into perpetuity. And preferred stock is usually rated by the credit rating agencies. They rate companies and securities just like individuals are rated with FICO scores. In some cases, preferred stock may contain a sinking fund provision, which merely means that the company is required to set aside a certain amount of money periodically to purchase or call its existing preferred stock issue. Now let's take a look how this compares with bonds. So bonds are also issued in the capital markets and are assumed to be long-term financing. Bonds pay fixed coupon interest payments that are calculated by taking the coupon interest percentage and multiplying it by the bond's face value of 1,000. Unlike preferred stock, the coupon interest payment on a bond is tax deductible to the bond issuer, and investors who purchase a company's bonds can force a company into bankruptcy if the company does not make its interest payments in full on time. Bonds can be callable in some cases at the company's option, and they can also be convertible into common stock. Unlike preferred stock, bonds have a set maturity date, so they do not pay into perpetuity their coupon interest payments. They too are rated by the rating agencies, and the bond issue can contain a sinking fund provision. Now let's take preferred stock and let's look at it versus common stock. So as we already said, there's no maturity date on preferred stock. It is assumed to exist forever as long as the company is in existence and has preferred stock. People who have invested in preferred stock do not get the right to choose a company's board of directors, nor do they have voting rights. Companies can issue multiple series of preferred stock that have different characteristics. Some of a company's preferred stock issuance can be cumulative, which basically means that if dividends have gone unpaid for a period of time, those preferred stock dividends must be paid first before the company can declare or pay common stock dividends. We're going to talk more about valuing preferred stock in this video, but also recognize it is a limited liability instrument. So the investor in preferred stock can lose their entire investment that they paid to buy the preferred stock, but they can't lose more than that. Now let's turn to common stock. And like preferred stock, common stock is assumed to exist forever as long as the company keeps its shares outstanding. But unlike preferred stock, common stockholders have the right to choose the board of directors of the company, and they have voting rights. Common stock, just like preferred stock, can be issued in multiple series that have different characteristics, but common stock, unlike preferred stock, is typically unrated. And in terms of valuing common stock, it's similar to preferred stock in that we are looking at the expected future free cash flows, and we are discounting that back by some required rate of return. And preferred stock and common stock are both limited liability instruments. So preferred stock trades just like common stock does. And so here is an example of some listings of preferred stock quotes. Notice there are stock symbols for each of the preferred stock issuances. They have the current price. They also have the 52-week high and low, and it lists the annual dividend that's paid by each one of these issues. So you can go online and find preferred stock quotes if you so desire. So let's talk a little bit about how we calculate the value of preferred stock. Since it's a perpetuity and presumed to pay forever, the equation for preferred stock valuation goes into perpetuity. And it works like this. You take the dollar dividend of the preferred stock that is expected to be paid in the first year. You divide that by 1 plus the required rate of return raised to the time period of 1 for 1 year. You add to that the dividend amount that should be paid in year 2, which is going to be the exact same as what was paid in year 1, because it's a fixed dividend. And then you're going to divide it by 1 plus the required rate of return raised to the 2, and then so on and so forth. But since this is a perpetuity that is presumed to pay a preferred stock dividend forever, we can simplify this valuation equation to just taking the dollar annual preferred stock dividend and dividing it by the required rate of return. Let's look at an example. And these are all made up examples, so the companies are real. PG&E's preferred stock pays $1.25 annual dividend. If you are the investor of this preferred stock, you have a required rate of return of 5%. What is the intrinsic value of PG&E's preferred stock? Another way of saying that is, what should the price be for this preferred stock? How much is it worth? Another way of saying that is, what is the present value of the expected future free cash flows from this preferred stock investment discounted at the required rate of return of 5%? So following the equation, we take the dollar annual dividend of $1.25 divided by the required rate of return of 5%, and we get $25 is the intrinsic value of PG&E's preferred stock. This is where it should be trading based on its expected future free cash flows. Now let's look at another example. In this example, AT&T has 6.375% preferred stock outstanding with a $25 par value. If you are the investor and your required rate of return is 7.2%, what is the intrinsic value of AT&T's preferred stock? Well, first of all, this is typically the way preferred stock dividends are quoted. They're quoted as a percent. So in order to determine the dollar amount of the dividend, you just take the percentage times the company's par value. And unlike in bonds, the par value will change for preferred stock. So you have to know what the par value is for the company that you're considering. And then you divide that by the required rate of return. So we would take 0.06375 times $25 to get the dollar dividend, divide that by the required rate of return of 0.072, and the intrinsic value of AT&T's preferred stock with this required rate of return is $22.14. So that's where it should be trading. That's its present value. Now, if, however, in the market, AT&T's preferred stock is actually trading at $25, do you want to buy it? Well, if you have a required rate of return of 7.2%, which is what was given in the problem, then you believe that the value of AT&T's preferred stock should be $22.14. So if the stock is trading at $25, we would say it's overvalued. It is trading for more than what you believe it is actually worth. Therefore, you would not be interested in buying it. Okay, let's look at another example. What is the market's expected rate of return for Disney's preferred stock that has a $100 par value, pays a 3.64% annual dividend, and has a market price of $50? So we can use the equation, we just rework it a little bit to try to find the expected rate of return on this preferred stock investment. So you take your dividend percentage, you multiply it by the company's par value. So that would be 0.0364 times 100, 3.64, divided by the market price of $50. That would give you an expected return on this preferred stock for Disney of 7.28%. Now, if your required return for Disney's preferred stock is 5%, should you buy it at $50, which is where it's currently trading? Well, so let's look at this. So if you evaluate the expected future free cash flows for Walt Disney's preferred stock, and you've determined that it will be appropriate for you to achieve a required return of 5%, notice that that required rate of return is less than the rate of return that is offered by the market price of $50. So you would most definitely be interested in buying this preferred stock at $50 because it's offering a higher rate of return than what you actually require. Okay, that's all for today. Thank you very much for watching this video. Until next time, this is your Finance-ista, Cynthia Bush, signing off. Don't forget to subscribe to my YouTube channel. See you next time.